Overdraft fee revenue dropped 48% between 2019 and 2023 from $15.5 billion to $8 billion. Financial journalists celebrated. Here's what didn't make headlines. Non-interest fee income at large U.S. commercial banks still accounts for 30 to 35% of total revenue, same as before. The specific fee shrank. The revenue dependency didn't move. The wins are real. Bank of America cut its overdraft fee from $35 to $10 in 2022. Wells Fargo eliminated NSF fees entirely. Capital One dropped overdraft fees to zero. The CFPB's own data shows roughly 9% of checking account holders were paying 80% of all overdraft fees, and that concentrated group saw genuine relief. In January 2025, the CFPB finalized a rule capping overdraft fees at $5 for banks with assets over $10 billion, projected to save consumers $5 billion annually. The rule faces active legal challenges from the American Bankers Association and Congressional Review Act resolutions. Its survival is not assured, but the pressure produced measurable dollar-denominated results for the people most exposed to overdraft extraction. Three mechanisms explain why total fee revenue held steady. First, fee substitution. When overdraft income declined, monthly maintenance fee revenue at top 10 banks rose roughly 18% between 2021 and 2023, per FDIC call report data. Wire transfer fees and account service charges expanded simultaneously. Domestic wires cost banks negligible processing expense, yet they charge $15 to $30 while Zelle processes the same transfer for free. Second, minimum balance weaponization. The average minimum balance required to waive a monthly fee at a top 10 bank rose from $1,500 in 2019 to $2,200 in 2024, per Bankrate's annual checking survey. That's not a fee. It's a forced interest-free deposit the bank lends out at prevailing rates. Third, float recapture. As overnight rates climbed from 0.25% to 5.25% between 2022 and 2023, net interest margin on those captive non-interest-bearing deposits replaced a meaningful share of lost overdraft income. All three share the same logic. The specific fee is negotiable, the extraction rate is not. The most counterintuitive part, the regulation most explicitly designed to help consumers made large bank fee structures more aggressive. The Durbin Amendment, passed as part of Dodd-Frank in 2010, capped debit card interchange fees for banks over $10 billion in assets at roughly 21 cents per transaction, down from 44 cents. The share of large banks offering free checking fell from 76% in 2009 to 38% by 2012. The Fed's own 2013 analysis estimated banks lost approximately $8 billion in interchange revenue and recaptured roughly $5.5 billion through new or expanded account fees within 3 years. When Bank of America announced a $5 monthly debit card fee to replace lost income, a Change.org petition hit 300,000 signatures in weeks, and the fee was canceled before it ever took effect. Wells Fargo and SunTrust, piloting identical fees, dropped them simultaneously. Consumer collective action can kill a visible fee. Banks will find a less visible route to the same revenue. That is precisely the pattern the 2023 overdraft victories may now be replicating. Neobanks gave millions a real exit. Chime, Current, and Dave collectively serve over 30 million accounts. No overdraft fees, no minimum balances. Cornerstone Advisors estimates their customers save roughly $1.2 billion annually versus legacy bank equivalents. But Chime's model is revenue rerouting. Operating below the Durbin Amendment's asset threshold, it earns roughly 44 cents per debit swipe versus 21 cents for a large bank. That interchange advantage funds the free model and evaporates if assets cross $10 billion. More critically, look at who switched. Households earning under $30,000 per year, the demographic paying the highest share of overdraft fees, have smartphone ownership rates 22 percentage points lower than higher income households and are significantly more likely to distrust online-only institutions, per FDIC 2023 survey data. Neobanks succeeded most with younger, digitally fluent customers already least exposed to predatory fee structures. Legacy banks' most fee dependent revenue is now concentrated in their most financially vulnerable remaining customers, more entrenched for the population regulators were trying to protect, not less. Fee revenue is structurally load bearing, engineered into the institution, not bolted on. Every time one fee line is compressed, the pressure migrates somewhere less visible. The Durbin Amendment proved it. The post 2019 overdraft decline is proving it again. Think of fee revenue as pressurized, cap one outlet, and the pressure doesn't drop, it redirects. The customers who got relief are real. The $8 billion still flowing is also real. The mechanism connecting those two facts is what determines where the pressure goes next. Opt out of overdraft protection today. Find your monthly fee waiver condition. Make the invisible visible.